Welcome back to Vantage. We had our growth conference earlier this month and we're sort of playing on the theme. So I'm actually delighted to have a manager who's been on before. He runs a thematic fund. Welcome back to Vantage, Alex.
Always a pleasure to be here, Neil. Thank you.
And for those who haven't seen you previously, perhaps you could just briefly introduce yourself, introduce the fund, the objectives of the fund, the philosophy, and then we'll get into a little bit more of the detail.
Yeah, 100%. Lots of ground to cover then, Neil, without a doubt. So just to remind everyone, my name is Alex Guns. I run the Future Trends Fund at Heptagon Capital.
Yeah.
Heptagon's a boutique founded in 2005. We manage and advise on over $16 billion of assets. I set up the fund in 2016, so it passed its 10-year anniversary in January. And the strategy is a concentrated yet multi-thematic fund. So we invest in everything from logistics to longevity. And the idea really is to identify those long-term trends that we think are going to grow in importance broadly, regardless of what's happening to GDP, where governments and regulators, if they're present in the industry, are tailwinds rather than headwinds, and then find the businesses that are best placed to benefit from those trends.
Thank you, and congratulations on 10 years, firstly. And I have said it previously, but for viewers who want to learn more, you've got a great website, great resources. You write regularly on some of the themes, and those are accessible on the themes. One of the things that stood out for me, and it was one of the themes we were talking about in the conference, was one of your statements that around AI in particular, which is that actually you have a preference for the shovel makers rather than the miners. What do you mean by that?
This is something we've talked about many, many times, and not just within the sphere of AI, Neil.
Yeah.
And really, the idea is that we think technology is an enabler, a means to an end. And really, what I perhaps should have highlighted to listeners earlier on is that the strategy that we manage, and consistent really with all of the other products on the Heptagon platform, is that by definition, by design, they really emphasize high active share. So in other words, we are looking for differentiated businesses. And the reason we think why asset allocators want to focus on our products is because of that element of differentiation. But to respond to your question, I think normally what you see with a trend such as artificial intelligence is that really you move through three phases. First of all, you have the infrastructure, then you have the platforms, then you have the applications. We're still very much in the infrastructure phase at the moment, but I think what's almost forgotten is that you need a whole set of supporting elements, supporting businesses above and beyond the GPU chips and the data centers that are often talked about. One expression that I know we've discussed in the past and was a theme at your conference last week, Neil, is this idea of halo assets, so heavy asset, low obsolescence businesses.
Yeah.
And this is really something that we've spent a huge amount of time thinking about and implementing in our investment strategy. Very happy to give an example if that's helpful.
Yeah, I mean, so look, I was a great segue because I was going to ask you about it because you wrote about it post the conference. So firstly, for those who've never come across Halo, what does it actually mean? So how do you think about it? And maybe, bring it to life by give us an example of, how you buying into that within the fund.
Yeah. I sort of figured this topic was likely to come up, so on the way here I was thinking about an example, one of the most tangible ones, and when we're literally talking about heaviness. And the business that sprung to mind, this is a business, for record, that we've invested in, or been invested in, since 2017.
Yeah.
And it's a Dutch business called ASML.
Yeah.
To highlight for listeners who may not be familiar with this business, and obviously we'll come back to how this fits into Halo in a second. ASML is a Dutch business. It is the producer of the machines that make semiconductor chips. Yeah. We've said before, perhaps even on one of the Vantage shows in the past, the future simply can't happen without this company. So if you think about one of their machines, these machines, they literally weigh 100,000 kilograms. That's immense.
Yeah.
If you are building one in the Netherlands and then shipping it, say, to Taiwan, to TSMC, who's a major customer, it needs to be packed into 13 crates going across 3 cargo planes. So this is real heavy infrastructure. These machines have a list price probably starting at 120 million euros. And this is a business that for many, many years was not on investors' radar screens at all. And really, I think it captures perfectly this idea of, number one, differentiated assets, Number two, something which is pure halo. And number three, something which is a metaphorical shovel maker. In other words, it is something which is integral to the whole process of actually building out artificial intelligence.
Okay. And again, so just to go through why Halo, yeah, I mean, I think, we talked about it, that, Claude suddenly came out with his legal services plugin. All the software companies suddenly were being questioned around their economic moat because AI is eroding it potentially. There are certain areas where actually they are defensible. We don't see AI eroding those moats. So heavy assets, you're not going to see oil wells disappear because of AI, etc. So that piece is really interesting. And low obsolescence, meaning, okay, there is longevity in terms of what they do. I think that matters as well. I think your point about ASML is great, which is that there is, if you want to participate in this industry, you have to turn to ASML. Yeah,
Yeah.
there is no obsolescence in that story, and yes, we'll normally look how much of the business is represented by tangible assets. It's a big manufacturer, so a great case study. Now, some of the stats that if I've been reading your material, so some of the stats you've been sharing is, I would describe it as genuinely staggering. $700 billion of AI infrastructure spend from the US hyperscalers alone this year. A single Utah data center that will consume more power daily than the whole of London. And the 100,000 tons of steel per gigawatt of capacity. Now, the one number of comparison that Chris, what is the one sort of number that really stands out for you that sort of crystallizes the sheer scale of this build-up?
It's a wonderful question, and I will answer it in just one moment, Neil.
Yeah.
But I think it's maybe helpful for listeners to frame the context of a couple of those statistics you
Yeah.
mentioned previously, almost to go back a step.
Yeah.
Every statistic we read, you read, I read, many of our listeners read, will probably fall into that staggering bucket.
Yeah.
The first one you cited, $700 billion of infrastructure spend, and that's just by the major hyperscalers, so
Yeah.
big cloud providers. At the start of this year, that figure was $450 billion. By the end of this year, best guess, it could top $1 trillion.
Yeah.
Pardon me. The other statistic that I found that I think is relevant is you talked about 100 tons of steel going into a 1 gigawatt capacity data center. To frame that, we're here in London. If you take Wembley Stadium, 23 tons of steel in that. If you take the Shard, 10 tons of steel in that. And these are both huge, iconic buildings.
Yeah.
So I think hopefully that gives some context to just how much steel is going into a data center. If you ask for one specific statistic, I would say it is the percentage of GDP in the United States that is being spent on this whole infrastructure build at the moment.
Yeah.
Today, we're at about 5.2% of US GDP. When telecoms network operators were building out fiber during the dot-com boom, that was about 5%. So we've crossed that figure already. But in terms of where might we get to, two possible examples spring to mind. Number one would be residential fixed investments, i.e. when you had the housing boom in the United States in the mid-2000s, you peaked at about 7.5% of GDP.
Okay.
And then clearly with the railroads in the 19th century, you peaked at about 8% of GDP. So I guess what one could infer from all of this is that the infrastructure build still has quite a long way to run.
Yeah.
As many people will be aware, NVIDIA, biggest company in the world, had their results earlier on this week in the middle of May. And Jensen Huang, CEO, he actually described what's going on at the moment as, quote unquote, the biggest infrastructure build known in humankind.
Yeah.
And I think really
Yeah.
this is the correct way to think about current dynamics.
Yeah, that's a great way of illustrating it. Okay, one of the things, it's like, given the scale of the build, one of the concerns is around bottlenecks. And you've highlighted that, there are projects waiting potentially 10 years for grid connectivity. And, there's quite a lot of delay and deferment effectively in a lot of the US data center projects, for instance. Where in the value chain do you see the sort of tightest bottlenecks? Because I'm assuming that's where you see, potential pricing power and potential sort of margin sort of creation. Is it power generation, transmission, steel, cooling, permitting? What are the sort of areas that you focus on?
I would say, Neil, that the simple answer to that question is all of the above. So, in other words, pretty
Yeah.
much every single business we talk to. I
Yeah.
was in the United States on the East Coast in March, and this was probably one of the most consistent messages from meeting with businesses there.
Yeah.
Perhaps a couple of comments that might help frame or broaden out the discussion. So really, it's fascinating when you look at many of the companies, as you alluded to in our universe, and I'm thinking about Siemens Energy, which builds out grid infrastructure. I'm thinking about First Solar that manufactures solar panels.
Hmm.
I'm thinking about Quanta Services that effectively is laying the cables that go across the electricity network. Even Prologis, which is the biggest owner of industrial warehouses in the world, they're converting some of those typical big box warehouses you see on the edge of motorways, near airports and so on. They're converting some of those into data
Yeah.
centers.
Yeah.
And the message we hear from pretty much all of those businesses is that when you think about line of sight and demand, they are taking orders now that they envisage, and that's really the crux word here, envisage being filled in the early 2030s.
Yeah.
So that, I think, gives you a sense, or gives our listeners a sense, of that imbalance between demand and supply. Obviously, what this implies and what we look for in the businesses in which we invest is, do they have pricing power? How effectively are they able to exercise that pricing power? And maybe one final really quick observation. I think in some ways this almost comes back to economics 101. What we really care about is where there is a tangible scarcity of an asset. So the two I'd call out in particular, and in some ways this links back to Halo again. Number one would be land. Until we go to the moon, so to speak, there is only a finite number of places in the United Kingdom, in the United States, anywhere else where you can physically find the available land to build a data center. And then the second dynamic is, and we again hear this from a number of the businesses we invest in and we talk to, it is just actually having those really skilled people who physically know how to
Yeah.
dig a trench or climb up a pylon to stitch cables together. And those for us are really, really interesting areas.
Let's focus on the fund itself, okay? So it's a concentrated holdings, typically around sort of 25, and we don't necessarily want you to sort of recommend things to people, but I believe in talking through your holdings, you're bringing the story, the investment process to life. So I think you've illustrated some great examples as we've gone through Halo, as we've gone through the infrastructure build of the kind of stocks. Give me a couple of other things that you're sort of invested in and the themes that they're exemplifying.
100%, Neil. And just to remind everyone, this is by design a multi-thematic strategy.
Yeah.
So we're looking at a whole range of different things.
Hmm.
I'd like perhaps to begin by circling back to one of the names we touched on earlier, because to our mind, it actually plays to a huge number of the future trends in
Yeah.
which we invest. This is a company called Quanta Services. They're based in Texas, and they have the largest workforce in the United States that are actually involved in upgrading and repairing grid infrastructure. And it's really interesting. Every time you meet with Quanta, I met with them in London earlier on this month, actually,
Yeah.
and they will highlight that, forget AI for a moment, there are actually a couple of other dynamics going on. If you think about it, most grid infrastructure, whether in the United States, in the United Kingdom, pretty much anywhere in the Western world, was built in 1945 or just after the Second World War. And therefore, if you think about what's happened since then, massive population growth, massive digitization of everything. So every time you order a pair of trainers on Amazon, you watch a new video on Netflix, whatever it might be, those are ones and zeros effectively traveling over your electricity network.
Yeah.
So networks need upgrading. We've got more weather extremes, so networks need hardening, if you will, for that dynamic. Geopolitics, which we may come to later on, is obviously becoming more of an issue. So networks are being upgraded to provide resilience against possible cyber threats. And all of this is providing an absolutely massive tailwind of demand for a business like Quanta, even before you get onto AI. One of the other really interesting statistics they will often highlight to investors is that you think about cloud, it may be quite normal for many businesses to have moved their workloads into the cloud, certainly say within financial services. But when you look globally, only about 30% of all workloads have been moved into the cloud. So when you're actually thinking about the criticality of different parts of the value chain,
Yeah.
pretty much everything today runs on electricity. The great news for a business like Quanta, just to really round out this case study before we move on to number two, is that about 80% of their revenues are recurring. In other words, they come from utilities, from government entities,
Yeah.
and therefore that provides great line of sight, great visibility, great cash flow generation. So Quanta would be number one. And then to pivot to a totally different theme, but also really honing in on this idea of very difficult to replicate, a classic Halo-like company. It's the business we invested in towards the end of last year called MDA Space.
Okay.
This one is less likely to be familiar to listeners. Although the company has a heritage that dates back to the very late 50s, they were involved in some of the early lunar landings. It's a company headquartered in Toronto, Canada. I was there in March. They were spun out of a larger business called Maxar and have existed as a single standalone entity only for a handful of years. Clearly, space is incredibly topical, as we know, with regard to the pending flotation of SpaceX.
Yeah.
This business is, dare I say it, benefiting from a halo effect in that sense. But whereas SpaceX is all about physically launching satellites into space, what MDA does is they actually build the hardware and the software for those satellites. And really our contention, again, in some ways it comes back to this whole idea about the data deluge, that data demand is growing much more quickly than networks can actually supply it or match it. Space is not about tourism. It's not about resource extraction, certainly not yet. It is all about effectively another way of transmitting and potentially longer term storing data. That's why you need the satellites up there.
Yeah.
The second thing, and again to link it back to geopolitics, is simply that pretty much everything that is sent up into space is inherently dual use. So in other words, it will have civil and commercial purposes. And space is only going to get more contested, congested, and competitive. And if you have a leading franchise in that area, we think this is a potential durable advantage.
That's great, and the space theme is something that we're actively looking at right now. So we will certainly take a closer look at that. You put out a view from the top, which is you giving your thoughts across different asset classes. I think the last one described equity markets as disconnected, all-time highs, but at the same time you've got credit spreads widening, yields increasing, oil at $100 a barrel. And I think that we should talk about risks. So if hyperscaler capex was to slow, or indeed the returns from it disappointed, how exposed do you think we are? And is there a risk effectively that the valuations have run a little bit ahead of themselves?
It's a great question and a very pertinent question, and I suppose there's several different ways of responding to it.
Yeah.
I guess what you may effectively be trying to ask, Neil, is how much is actually priced in today,
Yeah.
the extent to which equity markets in general or certain stocks are priced for perfection. And I think the two things that we find really encouraging dynamics would be the following. Number one, and really in contrast, say, to the late 90s when I began my career, is that this recent momentum that we've seen in equities has been driven much more by earnings upgrades rather than by multiple expansion. So that, in one sense, points to its durability. The second dynamic I'd call out is that whereas, say, the story in equity markets, if you will, for 24 and 25, and again, we may have talked about it on a previous program, it's this whole idea of the Magnificent Seven. What to our mind has been encouraging is actually that the rally has broadened, and that again speaks to its durability. The second crucial point I'd make, and this is something we've highlighted in View from the Top and really have done for many, many years now, is really we cannot overemphasize the importance of diversification. And I guess in one sense, this would speak to having a multi-thematic approach.
Yeah.
We're not just invested, as the case study showed, solely in the AI trade, and there'll be other areas we haven't had a chance to talk about today, like healthcare, like water, for example, that we also have thematic exposure to. More generally, if you step back, we're thinking about a broader macro view. Again, we advocate diversification within the equity market. We've made the case for some time at Heptagon For small caps, for example,
Mhm.
they haven't perhaps participated in the rally as much as the mega cap companies. And from a regional perspective, we continue to see value in geographies like Japan, and for the longer term, a geography like India too.
Okay. And perhaps one of the things that stood out for me is that in one of your pieces, you argue that the post-World War II rules-based order is effectively over, and that fiscal dominance may now become the new normal. And I think that your conclusion around that is that actually, because of that, gold and alternative asset classes deserve spaces. And so, tying into your theme of diversification, explain that to us. What do you mean by that, and what gets you interested in gold and alternative asset classes?
I think the simplest way of answering that question, Neil, is that for many years there has been a prevailing mantra, if you will, within financial markets about the merits, if you will, of a 60-40 portfolio.
Yeah,
What we mean by that is, crudely speaking, a 60% allocation to equities, a
yeah,
40% allocation to government bonds. If we think about what is arguably the new normal, the old geopolitical order has changed. That is pretty much accepted
yeah.
universally. So what are the conclusions of that? Number one, countries are spending more on defense now.
Hmm.
Number two, and this has really been brought to life in the last few months, countries are spending more on energy independence, building in resilience.
Yeah,
This is something which really began during COVID. It accelerated when Russia invaded Ukraine. It's now accelerated again. But the whole reconfiguring of supply chains, moving from just in time to just in case, is pervasive. That's going to carry on. At the same time, you've got a dynamic where populations are getting older, which means more expenditure on healthcare, arguably lower tax takes as well.
yeah,
The final dynamic would be that clearly there is a huge reluctance. It is a vote loser pretty much anywhere for governments to contemplate putting up taxes. The conclusion one might plausibly derive from all of this is that government debt levels are going up. Many people are of the opinion that debt levels are unsustainable. There'll have to be a reckoning at some stage. That's less of the debate for today. But I think from an investing conclusion, what should be abundantly clear is that the period of falling and indeed negative government bond yields
yeah,
that we saw in the 2010s, for example, that was the exception rather than the rule. The reality is that government bond yields are only headed higher, and therefore the role of fixed income, government bonds, in a portfolio as a diversifier perhaps is not as compelling today
yeah.
as it was in the past. Yes, to jump back quickly to AI, we are bulls of AI. We do think AI will improve productivity, and that could lower some of these pressures. But this is going to take, as we highlighted, particularly given the bottlenecks, a number of years
Yeah.
to really play out. So really, to come to the conclusion, equities, we think, are durable. Fixed income, we do not think is durable. And therefore, how do you fill that gap? How do you diversify adequately? And we think asset classes such as gold, such as physical infrastructure, again, arguably the halo point,
Yeah.
alternative asset managers, they are really well placed to benefit. And I suppose really to conclude in one word or one sentence, it is, as we cannot stress heavily enough, all about portfolio diversification.
Alex, thank you so much for being on Vantage.
Always a pleasure, Neil. Thank you for having me on the show.